Hello everyone, welcome back. In this episode, we will do a weekly review. We will look back at the core views we shared on this channel last week and see whether they were validated by the market. At the same time, we will look ahead to next week and discuss which areas may still have a chance to attract capital. Last week, our most important call was correct. The market is moving from believing the AI story to examining AI returns. This is extremely important. As we said before, the sharp rally on July 30th did not mean risk had disappeared. Instead, three things happened at the same time. AI earnings were validated, interest rate pressure eased, and sector rotation accelerated. First, let's look at the first stock that was validated, Microsoft, MSFT. Last week, our view on Microsoft was very clear. Microsoft was the most important stress test name in the AI chain. We said at the time that, after Microsoft's earnings, if Azure growth was strong and the market believed AI demand could translate into revenue, then the stock would truly win capital's approval. On the 27th, we said, the $377 to $382 range can be treated as a short-term watch zone. The subsequent price action proved that this view was correct. On July 30th, Microsoft jumped 15.5%. The call was validated by the market. The second stock that was validated was Amazon, AMZN. Our previous view on Amazon was that the key was whether AWS growth and capital spending could form a new balance. As long as the market believed that higher AI investment could be absorbed by stronger cloud growth, Amazon would have a chance to be repriced. On the 27th, we said, $230 can serve as the first watch level before and after earnings, while $235 to $245 forms the resistance zone for a rebound. On July 30th, Amazon surged 15%. The third validation came from our risk warning on Apple. Last week, we warned that Apple is different from Microsoft and Meta. The pressure it faces is not data center capital spending, but end device hardware, supply chain costs, memory prices, and growth guidance. After Apple reported earnings, the stock fell sharply. The WSJ noted that Apple dropped 7.4%, becoming one of the negative examples in this round of technology stock differentiation. 3. Overall trading approach for next week. What should we do next week? My view is this. Next week, do not blindly chase AI at the top. What we really need to watch is where capital may rotate next. The market now has three key characteristics. First, the AI sector has already started to diverge. Second, the Federal Reserve did not raise rates immediately, giving technology stocks a brief breather. But the risk of higher rates lasting longer still remains. Third, capital will continue looking for second-stage opportunities. What are second-stage opportunities? They are not the frontline GPUs or the most crowded AI chip names. They are the infrastructure that AI expansion cannot avoid, the platforms that benefit from market volatility, and defense technology companies with real order growth. Under this framework, I will focus on three stocks next week. The first stock, Eaton. ETN is the stock I am watching most closely next week. It represents AI power infrastructure. Why is this direction important? Because AI can change models, and it can change chips. But data centers cannot run without electricity. As long as companies such as Microsoft and Amazon continue building AI data centers, electricity, power distribution, cooling, and power management systems are irreplaceable links in the chain. That is why ETN connects the AI theme with non-AI cash flow. Capital is moving away from only buying AI chips and toward finding the second-order beneficiaries where AI capital spending is actually being deployed. Here is how I will watch it next week. First watch zone, $410 to $416. If ETN can hold this range, it would suggest that post-earnings buying support is still there. Short-term confirmation level, $420. If the stock breaks above $420 on strong volume and holds that level, the next area to watch would be the previous high resistance zone around $430 to $437. Pullback watch zone, $402 to $408. If the stock pulls back but does not break this area, it can still be kept on watch. But if it falls below $390 and cannot quickly reclaim that level, it would suggest that the post-earnings strength may have been only a short-term sentiment rebound, and that the AI power infrastructure trade may be cooling for now. The strategy for next week is to wait for a pullback or wait for breakout confirmation, not to chase the stock higher. The second stock is CME. What is the market trading every day right now? AI earnings, rate expectations, inflation, oil prices, currencies, and index volatility. In this environment, the real beneficiaries certainly include platforms that provide trading, clearing, risk management, and market data. In terms of execution, $270 to $272 is the first confirmation zone. If the stock can hold this range on strong volume, it would show that the trend remains strong. After that, we can watch the $280 to $285 resistance area. $260 to $263 is the first pullback watch zone. If the stock falls below $255 and cannot quickly reclaim that level, it would suggest that this round of pricing, driven by market volatility and trading volume, may be starting to cool, and the setup needs to be reassessed. The third stock is AVAV. This one is different from the first two. It is the most offensive and the most volatile of the three. AVAV represents defense technology and unmanned systems, including drones, counter-drone systems, loitering munitions, and related areas. As we said in the previous episode, AVAV is not a defensive stock. It is a high-beta offensive name. Why should we still watch it next week? Because it has real orders and real revenue validation. But I want to emphasize, AVAV cannot be treated like a defensive stock. It is more suitable for small position observation and for waiting for confirmation. It is not suitable for heavy position chasing. For next week's execution, $145 to $150 can be used as a light position watch zone. $138 to $142 is the better core support zone. If the stock pulls back to this area and stabilizes on lower volume, the risk-reward setup would be better. On the upside, only a valid breakout above $155 to $160, together with expanding volume, would show that the trend has truly strengthened. If that breakout succeeds, the next resistance to watch would be around $170. If the stock breaks below $135 on heavy volume, adding exposure should be paused. If orders continue to grow, but margins or cash flow do not improve, expectations should also be lowered. To conclude, last week we anticipated two rising stocks and avoided Apple's decline. We were not distracted by its return to the top of the market cap ranking. Remember this rule: only a continued rally on strong volume after good news is true strength. If a stock does not rise after good news, or even falls on heavy volume, that is a risk signal. This is also the framework our channel has always followed. Earnings determine short-term elasticity. Interest rates determine the valuation ceiling, and cash flow determines who can go further. This content is for market analysis and risk awareness only, and does not constitute investment advice. Before investing, please make independent decisions based on your own investment horizon, position structure, and risk tolerance.